All right, you've probably heard about the collapse of Silicon Valley Bank a couple of weeks ago. And I just want to take a minute, since this whole YouTube channel is all about venture capital, to talk about Silicon Valley Bank, what happened, how it all happened, as well as the impact that it has had, will have, not just on venture capital, but on the economy as a whole. You know, I think this is really important to understand because a lot of people look at Silicon Valley Bank and say, well, whatever, it was just, they just banked, startups, this is not my problem. But what you've seen is a massive shake in the overall industry, and it's something you need to understand. And I think understanding the dynamics of how Silicon Valley Bank collapsed, as well as the collapse of Signature Bank and Silvergate, and now the purchase of Credit Suisse by UBS. These things are sending tremors throughout our banking system, and the Fed is reeling and trying to react to add more stability and more confidence into the system. Stick around though to the end, and I'll share some tips on how you can best position yourself, whether it's through your investments or your job and you personally, to weather this storm. So first of all, we need to understand what happened to Silicon Valley Bank. Now, to do so, you gotta kind of back up to 2021. Now, 2021 was like this bonanza of venture capital. And really, it was the culmination of a decade-long policy to add more capital into the global economy. So basically, the Fed was lowered rates and lowered the effective cost of capital to essentially zero. And so you had all this money that was out there flowing around, searching for returns. And when your cost of capital is basically zero, then you can take all kinds of risky bets. And so what you had was an unprecedented flow of capital into venture capital. Essentially, you had all this money trying to find as much return as possible, and it was looking at the returns of venture capital, and venture capital can have phenomenal returns, particularly in bull markets. And so these VCs, like every year was up and to the right, and so they were showing like better and better and better performance, and then investors were putting more and more and more money into it. And if you think about like how many companies are publicly traded today versus 20 years ago, right, that number has basically been cut in half. And a lot of the returns that have been driven by companies have been realized more in the private sector than they have in the public sector. And so you had all this money flowing in trying to capture these returns. Well, what does this have to do with Silicon Valley Bank? When you had a bunch of venture capital funds raise a ton of money, those venture capitalists then were investing in startups, and they were competing for the very best deals and putting in tons and tons of money into these startups. And so these startups were raising more and more money at higher and higher valuations. Well, that money has to go somewhere, right? So I, as a venture capitalist, I go and I say, hey, I want to invest in the next great company. And so I write a check into that company, and I partner with some other investors, and maybe we give the company $100 million. So that $100 million, that company takes $100 million, and they're going to take it and they're going to put it in their bank account. Well, a lot of companies banked with Silicon Valley Bank because Silicon Valley Bank made it really easy to do business with them. And they also did some interesting things to encourage more deposits into their bank. So for example, they would do what's called venture debt. Now, venture debt is this interesting venture investment, essentially, where instead of investing equity into the company or buying equity in the company with your investment, you're loaning money to the company, and it's kind of sort of backed by the equity of the venture investors, and can be a way to get like more leverage on your round. So for example, if you raise $10 million from venture capitalists, maybe you raise another kind of 2 to 3 million in venture debt. And the way the venture debt works is you give what are called warrants or options to buy stock in your company at a future date at a given price. So basically, SVB would get a little bit of equity in the company, and then the startup would just pay them interest. And then over time, they'd refinance the debt, and they could refinance it with SVB, they could refinance it with somebody else. And if anything, if the company ended up failing, SVB would get paid out first, and then the venture capitalists, and then common, and so on and so forth. So a lot of companies wanted to raise venture debt, right? Because really, you're just paying the interest. You don't have to pay the upside on the equity like you do with venture capitalists. So it's relatively affordable capital. And so they would raise this venture debt, but SVB would say, hey, if you're going to raise venture debt from us, that's fine, but you have to bank with us too. They would go to them and say, okay, let's say I raise $100 million, right? Because there are all these VCs trying to throw money into my company because they're trying to put money to work. Then I'm going to raise all that money, and then maybe I get $10 million more venture debt. I'm going to take that $110 million, I'm going to put that into the bank, right? Now, the way banks work, and this is really important to understand, is that banks make money by taking the money you've put in there and lending it out to other people. When you put your money into the bank, you're making an investment. Now, most people don't realize that, but you are. And the reason I think people don't realize it is that for like the last decade and a half, you put your money in the bank and you get paid nothing, right? You might get like 0.00001% interest payment on that. And so they just assume like, oh, well, I'm not getting paid interest on it. It must just be like sitting there, right? But the reality is banks have been taking your money, whether it's in a savings account or a checking account, and they've been lending it out to other companies and other people, right? Mortgages, cars, business loans, all of those different things. They generate interest on that, and that drives their own profits. What happened is Silicon Valley Bank would go out and say, hey, yeah, we'll give you this venture debt, but you got to put all of your money into the bank with us. So they would lend out like $10 million and they would get $110 million back in deposits. Well, then they could take that $110 million of deposits and they could loan out a portion of it. And the portions varied, right? Because the federal regulators would come in and say, you can't lend out all of it because you have to have some money on hand in case that startup comes back and says, hey, I want my $110 million back. And those are what are called reserve ratios. And so those reserve ratios typically are, depending on the bank, 20, 30% or so. But that left like $70 to $80 million that could be loaned back out. And so what Silicon Valley Bank was doing, right, in 2021 is they were getting a whole bunch of deposits and they were lending out some of it. But the problem is that they couldn't lend out enough of it because there was so much money coming into the bank and there weren't as many startups looking to raise additional venture debt, or at least enough venture debt to cover their deposits. Now, there were other types of loans that Silicon Valley Bank was able to make. So one of those was capital call lines. Now, a capital call line is basically a loan made to a venture fund so that they can make their investments more quickly. So, and the way that works just really quickly is if I'm going to invest $1 million into a company, let's say, I need to call up all my investors and have them wire me money. Well, that could take a couple of weeks. And so instead of waiting those couple of weeks for it to come in, I have a capital call line with like a bank like Silicon Valley Bank. So I call up Silicon Valley Bank and I say, hey, I need $1 million to invest in this company. They wire me the $1 million. I wire it to the company. And then over the next 2 weeks, as my investors wire in their money, I pay off the loan. That represented about 54% of Silicon Valley Bank's outstanding loan balance. And those are relatively safe loans. Really, the problem they had was there's kind of a finite, number of those deals they can do. And then they were also kind of capped on the venture debt they could do. That represented about 25%. And ultimately, what ended up happening is they just ran out of places to put the money. And so they were like, hey, we can't just have money sitting here, right? Inflation alone is eating away the value of the money. So let's put it into treasuries. So they put the money into these US treasuries. And the idea was, hey, these treasuries aren't paying much, right? They're paying less than 1%. But that's okay because the Fed told us really clearly, like, hey, we're not going to increase rates. And if we do, we're not going to increase them super fast. Like, worst case scenario, like 2%, right? Max. And these banks were tested based on like a 2% interest paid on those treasury bills. So fast forward, it's now 2022. The Fed is increasing rates super fast. Not only is the Fed increasing rates, but as the Fed increases rates to fight inflation, what happens to the cost of capital? Well, remember earlier when I said because the cost of capital is really low, that led to companies raising a lot of money because venture capitalists had a lot of money to put to work. Well, all of a sudden, the cost of capital goes up, right? Rates go up, and there's a huge contraction on the amount of money that's out there. And so all of a sudden, these startups are either immediately seeing a cash crunch or being terrified of a cash crunch. And so what do? they start trying to cut their burn as much as they can, the amount of money they're spending on their business. And so that's why you've seen record layoffs kind of across the board. But the other thing is they start pulling, they start realizing like, hey, I can't raise more money. And so they start pulling money out of their bank account, and they're pouring more and more. And pretty soon they pulled out all of the money they borrowed. And then they start pulling out the equity. And you've got companies that are starting, on the brink of failing. It used to be that like companies would raise with tens of millions of dollars in the bank, and now they're trying to like stretch that out as far as they can. Well, what that means for Silicon Valley Bank is you have all of these startups that are starting to pull more of their money, their deposits, out of the bank. And the bank has to pay out the deposits, right? But if they've invested in things that aren't super liquid, right, they're going to eat through their reserve ratio of the cash that they have to kind of sitting around to fill deposits, and they're going to have to start selling assets. And those assets would be like loans and startups. It could be these treasury bills. And it could be the loans to venture capitalists through their capital call lines. Now, the capital call lines, that's a relatively fluid asset, but not really something you can easily sell. The loans to startups is a little more, marketable, but not as marketable as your treasuries. And so the bank had these treasuries, and you basically have like two types of treasuries. You have the ones that you're not going to sell. You're going to hold them to maturity. You're going to take your couple percent or less than 1% return on those treasuries, and it's fine. You don't lose money on those. They just kind of sit there, right? But then you have these other treasuries where you sell them. And the thing you have to understand about bonds, the way a bond works is that it's a finite period. So let's say I buy a US Treasury that pays 1% interest over a 2-year period. Well, what that means is I'm going to buy the bond for, let's say, $1,000. And then over the next 2 years, I'm going to get paid interest payments until I've received, 1% annually. So $120. I'm going to get paid interest on those over the next 2 years, so that by the end of the 2 years, I will be paid back the money that I loaned to the government or to whoever it is that issued the bond, plus 2%. So I'll get, if I put in $1,000, I'll get back $1,020, right? On 1% per year for 2 years. Okay, that's how a bond works, right? It's contractual. And the reality is, unless the company that issued the bond or the federal government, in the case of Treasuries, goes out of business, I'm not going to lose money on it, right? I may not make a lot of money, but I'm not going to lose money. That said, what if I have to sell the bond before it matures at the end of 2 years? Well, in that case, I need to price the bond lower in order to entice other investors to get it, because they're just going to get that 2%, right, on the 1,000. But if I lower the rate low enough, right, let's say I sell it for $900 to somebody else. Well, what that means is at the end of 2 years, they'll have paid $900 for it, but they're going to get paid $1,020 for it. And so they're getting paid a much, much higher interest rate. What does this all mean for Silicon Valley Bank? So Silicon Valley Bank bought a bunch of these treasuries at like 2%. But then what happened to interest rates? They went up. And so anybody that wanted to buy them was like, well, hey, if I'm going to buy your treasuries, they have to equal or exceed or whatever it might be the interest rates that I'm getting paid on buying a brand new treasury or buying them from somebody else. And so they had to lower the value of the bond and what they could sell it for enough in order to make up that difference on the interest that investors were demanding. Pull this all the way back to Silicon Valley Bank and their collapse. So they had to sell some of these bonds in order to pay the deposit demand from their customers, tech companies. And when they did that, they ended up taking a pretty meaningful loss. I think it was like $1.8 billion loss. And, they actually sold these bonds to Goldman at this loss. And then Goldman was like, hey, we'll help you raise the equity that you need to offset these losses. And so by all accounts that I've been able to read and see, it sounds like Silicon Valley Bank, with the support of Goldman Sachs as their investment banker, was able to pull together what they call a book, or in other words, like enough commitments from investors to meet that $1.8 billion loss, plus add another $500 million on top of it as additional buffer. Unfortunately, this whole thing collapsed really fast. And the reason it collapsed fast is because all the depositors, again, are these tech companies that have tons of money with the bank, right? It's not just like a bunch of mom and pops or individuals that have, 200,000, I don't know, 200 bucks, 1,000 bucks, $10,000, whatever in their bank account. No, this was large tech companies that had millions and millions of dollars sitting in these accounts. And so there were some venture investors primarily that looked at this and said, you know what? They just took this huge loss. If they can't raise the equity money necessary to cover this loss, the bank could be a little bit insolvent. We think it's prudent to pull our money out and tell our portfolio companies that maybe it would be prudent for them to pull it out. Well, this is a really tight-knit community. And so once one VC tells their startups to do it, those startups tell other startups, other VCs, all of a sudden, like wildfire, over $40 billion of deposits get pulled out of Silicon Valley Bank, like overnight, right? And if you think about what I was saying earlier, like Silicon Valley Bank had to liquidate some of these treasuries in order to cover the deposit demands, right? Well, it gets even worse when you have 40 billion get pulled out overnight. You all of a sudden you have to liquidate a ton of assets. And that created what is this bank run, where basically everybody comes and they demand their money because you don't want to be the last one. You don't want to be the last one to get to the bank and the bank has run out of all their cash. And all they've got are like these assets that are out there that aren't liquid that they can't get access to, right? Because that makes it really hard to cover things like payroll and pay for business expenses and all of those other things that you need cash for. So you don't want to be the last one. And so that creates kind of this incentive for everybody to go after the bank at once and deplete all of its assets overnight. So then, as you could probably imagine, after all this money gets pulled out of the bank, right, the equity deal totally falls apart, right? Nobody wants to invest equity into a company that is clearly it has massive liquidity issues and on its way to insolvency. And at that point, the FDIC stepped in and effectively shut down the bank. They're like, nope, no more pulling out deposits, nothing. We need to protect the underlying assets that are out there in the company so that we can protect depositors and what they've got in the company already. Because remember, there's a bunch of these assets, these loans out there to startup companies as well as to venture capitalists, and those are worth something. And as well as the treasuries, and those are worth something. And so the FDIC comes in and says, what we don't want to do is have the bank come under a tremendous amount of pressure, start liquidating all of these assets at super low prices to meet the demand from depositors, and ultimately end up hurting depositors, in the long run. So they basically shut down the bank. They took all of the assets. They moved it over to a new entity called SVB Bridge Bank. And then they went out and said, okay, we are going to insure and guarantee all deposits, no maximum. Because normally it's a maximum of $250,000 in your bank account that's insured by the FDIC. And they came out and said, any amount, we'll insure it. Because we don't want Silicon Valley Bank to fully collapse. It could be massively detrimental to the overall economy, blah, blah, blah. So they come in, they insure 100% of it, and they say, okay, Silicon Valley Bank employees, you need to go back and get as many of those deposits as you can back in the door. And if you can get enough, you can be a standalone entity. And if you can't, we're going to sell you. We're going to sell you as a bank altogether to another bank, or we're going to just chop you up for parts and sell you off, get as much money as we can for those assets, and then pay out all the depositors that have not been paid out yet. And that was their whole goal. So on March 27th, Citizens Bank acquired Silicon Valley Bank. And now Silicon Valley Bank is going to operate as a subsidiary of Citizens Bank. I wanted to do this video and really explain kind of the whole process because I think a lot of people are kind of glossing over the high level stuff. And the reason it's important is because Silicon Valley Bank, even though the Fed stepped in and the FDIC stepped in to backstop it, if we don't get this under control, this could end up impacting a lot of other banks. So, for example, Silicon Valley Bank's not the only one that had a tremendous amount of inflows of cash into the bank and didn't have a good place to put it. And so they bought treasuries and then other assets, which have declined in value over time. And that's going to impact their ability to repay depositors. That said, if we can have confidence in the banks and not go and demand all of our money back from them in the form of deposit withdrawal, then these banks can continue to remain solvent. So we're sitting at this precipice right now, where there are a lot of banks that are under a lot of stress right now from public investors who are basically saying, I don't know if this bank can survive this current environment, right? And if ultimately those banks aren't able to do that, we could see more bank failures over time. Now, I'm an optimist. I think at the end of the day, the Fed is going to come in, they're going to backstop a lot of these companies and these banks and ensure the deposits and so forth. And really, at the end of the day, all I care about is that my deposits in the bank are secure, right? And if I feel that way, then I'm going to continue keeping my money in the bank and supporting the bank and so forth. And I think that's really what needs to happen if we're going to avoid a massive banking crisis that could result in massive bank runs across a ton of different regional banks and even some of the larger ones, which, by the way, is why you have seen a number of large banks like JP Morgan step in to support banks like First Republic Bank by giving them a ton of money that they can use to backstop their deposits. Anyways, my best advice right now is look at your bank accounts. If you're banking with one of the very large banks, you're probably fine. If you're banking with a smaller regional bank, you're probably also fine, but you might want to consider moving some of your cash around so that you're within the $250,000 cash limit that's insured by the FDIC, just to be careful. And maybe you spread it around to a few other regional banks, for example. Or you can also, if you're a startup, check out some of the varying products that are out there that are doing innovative financial engineering to provide an increased level of insurance. Anyways, thanks for joining. I hope that was interesting. I think hopefully that was helpful in terms of how to understand what's going on in the current banking crisis, where it started, where it's going. Anyways, let me know what you think down below in the comments. And be sure to check out some of my other videos, like when I dissect Mr. Wonderful's track record on Shark Tank. Thanks.